Welcome to episode 1 of Compounding Brothers, the podcast where we dig beneath the headlines and figure out who's really winning. I'm Joaquin.
And I'm Paul.
Great to see you, brother. Glad to be here.
It's great to see you.
So, given this is our first episode together, why don't you briefly share with us your journey as an investor, in particular as a value investor?
Well, it's been sort of a rocky road. I started in the commodity futures and options brokerage and trading, and that led me into something called technical analysis, which I had to migrate from because it was frankly a lot of nonsense. So my journey was from a short-term, minute-by-minute technical analysis based trader to studying, really becoming interested in value investing, well, through Berkshire Hathaway, Charlie and Warren, seeing their letters, their presentations, and reading all the books that they suggested. And then took a accelerant through meeting you at business school. So I think we found that we were like-minded individuals, and we had a lot of fun, and we've kept a friendship and an investing interest in value-based investments for, gosh, it's been 25 years and
That's
going.
Right.
So yeah, it's been an interesting road. I've got a lot of scars, but I think I'm in a good mindset, have good mental models now as an investor. And always trying to sharpen the blade every day.
That's great. I think the experience, the mistakes made, is what makes you stronger as an investor. If you learn from the mistakes, I think one of the most important things, if you can, is to learn vicariously, right, through the mistakes of others. And that's what we try to do, and that's what we're trying to do here, and that's what's going to make us better investors. So in my case, it's interesting because I was taking this portfolio management class at Yale, and I remember this professor talking about the capital asset pricing model, and for whatever reason it didn't make any sense to me, and I dropped the class, but I had to fulfill a credit. So I said, what can I do? And someone told me there is a guy called David Swensen who's teaching a class in endowment management. I didn't know who David Swensen was, how ignorant I was back then. And I applied for the class like 2 weeks into the semester already, and they let me in for whatever miraculous reason. And it was not David Swensen, the individual, who made me see the light. It was one of his speakers. He invited one of his portfolio managers for the first half of the class, and then we discussed the case in the second half of the class. And one day, a gentleman named Seth Klarman, who I didn't know either, came into the room. And for me, that day was like an epiphany. It's as if the light came into the room, and I realized there is something else other than this nonsense I've been taught about efficient markets, about capital, asset pricing model, and beta. And then I got my starting reading Margin of Safety, and then The Intelligent Investor, and then I realized there was an individual named Warren Buffett. And then because of Warren Buffett, I learned about Charlie, and that's how I got going. So it's interesting. It's a meandering path. We're lucky that we're inoculated. Relatively early, not too early, it's never too early, but we got inoculated, and here we are. So that's what our channel is about. It's about sharing ideas that create outstanding returns in all market environments if you're a value investor by adhering to the right fundamental value investing first principles.
Yeah, that's right. Charlie said in a few of his speeches that there are many people with high IQs that are terrible investors because either they have the wrong philosophy, they have a bad temperament, or both. And they may also lack the skills to value a business. So I think this channel is our effort to spread the gospel, if you will, of value investing so people avoid making the mistakes that we've probably made in a lifetime of investing and get people wealthy quicker.
That sounds great. So we have a lot to cover. Let's take it away.
These are indeed fascinating times.
Indeed they are. So if we think in terms of what we're seeing today, it's funny because you and I have been talking about the opportunities in a very bifurcated market, and this is the piece that Jason Zweig published today in the Wall Street Journal. He's essentially saying people are selling the cheap to buy the expensive. There's been $13 billion exiting small caps at a time that 60 billion are entering the large cap, mega cap technology space.
Yeah, it's really interesting. The only other time when I've seen something similar to this was back in 2000. I remember I was buying Waste Management as a value investment when everybody was in tech stocks. And Waste Management went up when all the tech stocks crashed. And it was kind of the same thing that you're seeing now. Small cap value and international small cap value are very, very cheap. You find some great businesses. And it comes at a time when you're seeing some things even more grossly expensive than in 2000.
We're going to be talking about our 6 themes. We talk about the Technium and how technology is a living organism that is essentially taking over the world. At some point, we heard software is going to eat the world, and now is going to eat the world. And I think if you look at the news today also, we're talking about the Genius Act being passed. This is another theme we're going to be talking. I thought it interesting because it's as fresh as yesterday that all these things are panning out. Let me show you that all of this is happening in the context of what we're seeing historically very high valuations. We're seeing the S&P 500 forward PE at probably between 95th and 99th percentile of historical valuations. And it makes me think, when we were in the period after the internet bubble between Q1 2000 and Q3 2002, the market lost 4/5 of its value. The market, in this case, I'm talking as the Nasdaq Composite Index. And look at what happened in between. There were no fewer than 5 rallies. Of those 5 rallies, 4 of them were in excess of 35%. So it makes me ponder, isn't there a better way to play this opportunity than just to fall into things that are overbought and very expensive?
Yeah, I think that's you make a great point. There's a lot of human psychology in that chart. It's a fascinating chart, and we're living in an age where people have started investing and haven't seen really sort of proper bear markets, historical bear markets like 2000 or 74. So that's why everybody buys the dip. Everything recovers very quickly until it doesn't. We don't know when that'll happen, but when it does, people are going to get hurt.
That's right. And we're seeing these valuations at 22 times forward earnings. If we looked at the cyclically adjusted P ratio of our dear Professor Schiller, we will know that we are in the 99th percentile of historical valuations, north of 30 times cyclically adjusted earnings. And we are also basing those multiples out of very high, for the historical average, corporate profit margins. So we have a P that is at 22 in the case of the forward. We're talking about 36 in terms of a cyclically adjusted at a time when profit margins are also historically very high. And here, and we discussed this many times together, we're talking about one of the most mean reverting variables in capitalism. Competition creates margin pressure. And if we think that the multiples are high and the margins are high, I think it's a time to ponder and consider how much risk you want to take and how much you want to seek opportunities outside where the boom is occurring.
I couldn't agree more. If you don't do macro is going to do you. I think one of the things that I've learned from you over the years, well, you having been an economist, a master's in economics, and your deep knowledge of, you've taught me a lot about macro and how macro can aid you in investing. As value investors, we don't time the market. That's not what we're about. That's not part of our process, but it is good to have an understanding of the macro backdrop. So I think what you're talking about is very relevant. Jeremy Grantham has spoken about also the mean reverting nature of earnings. And we've got high multiples and high margins, and at some point those two are going to correlate on the downside, and it's going to get messy. And that's where we want to be. Where we want to be is where those people are. That's where we don't want to be.
That's interesting you say that, because I took this page from one of Barry Bannister's recent decks, and he has this over-under valuation chart based on enterprise valuation relative to economic profits, and it's impossible not to realize how similar the overvaluation looks today compared to what it was at the height of the internet and the dot-com bubble. And at the time, you had very high multiples, but you didn't have maybe as high profit margins. So you can conceivably argue that if there was a mean reversion in multiples and a mean reversion in margins, the potential downside could be larger than what it was then.
Oh yeah, absolutely. Harry, by the way, is a fantastic analyst. I had the pleasure of meeting him when I interned at Legg Mason, which is now Stifel, in between the two MBA years, and he was brilliant. Back in 2000, he picked one of his major themes were coal stocks, and those stocks went up X. So he's made some great calls over the years, and I think he's probably one of the best macro analysts out there.
I agree. He has a equally thought-provoking chart. You don't have to be Sherlock Holmes to understand the implications. On the left-hand side, he has the overvaluation and the performance after the crash between 1997 and 2001, and then he has on the right-hand side the performance between 2020 and 2026. Clearly, if you think in terms of what are expected returns for the Nasdaq 100, in this case, it's very hard to think that there's going to be a repeat of what we saw in the last few years, and it's very natural to think that expectations at the least need to be moderated, or if you want to continue generating incredible returns as we want here in this channel, probably the corollary of this chart is let's find opportunities elsewhere.
Yeah, that's right. That's absolutely right. Like Charlie Munger used to say, what do you do? And he says, the first thing I do is I know where not to be, and that's how.
He has a phrase which is, where do you go to fish? And the answer is where the fish are.
Exactly.
It doesn't seem that the fish are in the Nasdaq 100.
No.
The other thing, sorry?
No, definitely not. I agree with you.
Another sign of the times is how strong the role of passive investing and the implications of passive investing have become. And simply because you have this massive amount of assets coming into SPY-related indices or NASDAQ-related indices, what ends up happening is that the money flows to the stocks that are the most overvalued. And the more overvalued they are, the more money they attract, the higher their momentum, the higher their beta, and the higher the convergence of multiple strategies into a few selected, successful, quote-unquote, stocks. And the final result is that the market structure may have changed dramatically since Jack Bogle started thinking about indexing through today, and it may be the case that indexing is a mortal trap for many indexers. And this chart is showcasing a staggering statistic, which is that just a handful of stocks account for 50% of the market cap in 2025. And if for whatever reason there was a reversion, not only the reversion could be very sharp and very sudden, but that may create massive losses in a very high percentage of the investing public who have blindly followed the passive investing strategy.
Yeah, I think this is one of the biggest issues. This is an elephant in the room. It's good that you're pointing it out. There's Mike Green at Simplify has done some excellent work on this. And yes, it's the question, when does this end? Really, it's not going to sound right, but it's kind of like a Ponzi scheme. When money starts going out at a rate faster than it's coming in is when the shoe drops. And what's got to happen for that is you probably have to get employment to start declining, the boomers to start retiring, and selling equities. And that's, we don't know when that's going to happen, but this return chasing behavior in a smaller and smaller constituency of the S&P is very troublesome. And
yes,
Mike Green talks about a multiplier that for every dollar that goes into these passive funds, you sort of get a $17 multiple in the prices of these handful of stocks. It's just imagine when that goes the other way.
Spot on. So in terms of what we've covered so far, we've seen a market that looks expensive, at least in the historical comparison. We are looking at a market that is very highly concentrated, and at the same time, we're looking at a market that, in your own words, is highly bifurcated. So I love these three charts you sent me because they show that despite the fact that the market is concentrated and is on average expensive, largely due to a handful of stocks that have been skyrocketing, there still are pockets of opportunity. I would love you to talk about this a little bit.
Yeah, I think what the broad theme here is, because of all this indexing and passive, you've had a lot of money go into sort of a handful of stocks, and the stocks that are not in indices, which are a lot of small caps, international small cap value. So there's something to be said for size and the geography where businesses reside at the moment. And I think right now what these charts are telling us is that you want to go value rather than growth. You want to go international rather than U.S. And it's really fascinating how bifurcated this market is.
I agree. This is one of our 6 themes, and if you essentially create the intersection of the 3 opportunities, you end up with a sort of a Lollapalooza of small cap international value, where there is significant opportunity, and because of all the biases that we as investors have, we tend to neglect. We like things that we know, things that are close to home, and the opportunity in times like this is going to come from places like small cap international value.
Yeah. It's where nobody's fishing at the moment, going back to what you said before.
Yeah. And I came across this great paper by research affiliates, and they analyze a host of different strategies, and they're essentially finding that exactly things such as the one we're talking about here are at the most extreme undervaluation in terms of historical distributions. So things like value, mental, high dividends, quality, low volatility, those things are extremely cheap by the comparison. Going back again to this theme of bifurcated markets, the fact that the market on average is expensive doesn't mean that there are no fantastic opportunities as the ones you and I have been finding for the last few quarters.
Yeah, that's exactly right. Living through 2000 taught me that lesson, that there were, I mentioned Barry Bannister's pick on coal stocks. Those things started flying while the techs were crashing. So there always is a place that is undervalued, overlooked, where we can find some good businesses for the long term.
That's exactly right. I think this is the last page I wanted to discuss with you on this intro. And we've been hearing, especially during a bout of relative underperformance of the US, if you look at the red line, there was a blip on the top right hand, a blip. If we look at the long term, the US overperformance versus Europe and Japan is being staggering. And if Europe and Japan were to barely recover from this underperformance, goes back to the point of small cap value international, that's where the opportunities are. Here we don't have emerging markets, but in the case of emerging markets, the chart is further down than that of Europe. So the fact that the US is underperforming or may underperform is not based on the ending of US exceptionalism. It's based on the starting conditions that the US stock market is very expensive. And the US economy, which maybe is about 27% of the global GDP, the market capitalization of US-based companies is 2/3 of the MSCI world total market cap. So only by that percentage normalizing a bit, not necessarily going to 30% or 40%, but normalizing a bit, that would create a huge overperformance in emerging markets, Europe and Japan.
I think that's right. We love the US. We're both Latin American immigrants, but that doesn't mean we can't be agnostic about value. There's case in point here is Berkshire trimming their Apple stake, while at the same time buying Itochu, Mizuho, Sumitomo, Mitsui, which are the big trading houses and commercial houses in Japan. So the evidence is there that some pretty smart people are doing exactly that, are playing that value gap that you just mentioned.
Yes. Another striking development of the recent past is, for the first time in many, many years, if you look at the Japanese 30-year, we're seeing today a sharp increase. And this is something that is going to potentially wreak havoc on the yen carry trade. So even though this hasn't yet transpired in force in inhibiting the animal spirits in the US, we're starting to see things that, if they compound, can create cracks. You mentioned potentially baby boomers not being so aggressive in their savings or de-saving. We are seeing potentially cracks in the labor market, as you mentioned. And if those things start to add up, things can unravel. We're not saying that they are going to unravel in the next week or in the 3 weeks, but in terms of taking a macro view for the long term, why would we go and fish where it's expensive when there are opportunities in front of us of very cheap assets? And I think Japan Treasury at a record is one of those things that, again, makes me worried about that inflection point being closer.
Yeah, and there's, the carry trade is people borrowing in yen and investing it in US tech stocks. So putting it very, very simply. And what you're seeing now is that the yen is appreciating because the interest rates are improving, and that has the potential to escalate. Remember what happened back in August of 2024 when you had the yen spiking and you had a really big move in stocks to the downside for a couple days. Just imagine if this becomes secular rather than just a couple days blip.
Yeah,
these are the dangers. You point out that we don't time markets, we don't bet on these type of things, but what we do is we analyze the macro and we see how the probabilities stack up in certain areas. That's as much as we can do. and these are cause for concern.
Well said. Sort of cracking the armor of this market is that the Magnificent Seven are not performing in unison anymore. Even though they were the leaders and they were marching upwards for many quarters after 2022, especially year to date, only Nvidia, Meta, and Microsoft have been the leaders pushing the indices higher. Google, Apple, Tesla have negative returns so far. So we're starting to see more of a stock pickers market, and it's starting to be differentiation in the performance even among the Magnificent Seven. And one of these things that as an investors we need to keep an eye on is on this type of anomalies.
Yeah, these are part of the cracks, right? You mentioned the yen carry trade being in danger. This performance within the Mag 7 is another sort of part of the mosaic of worry that we have for the broader market.
Yes. And the other thing I wanted to share, get your thoughts on, is the fact that today you're paying north of 30 times earnings, forward earnings for the Magnificent Seven. You're paying 15 or 16 times forward earnings for the small caps value, and the EPS growth estimates are inflecting for both, while the growth rates for the Magnificent Seven, largely due to the large capex and the depreciation of the capex they are incurring to build their data centers, is declining. The EPS growth estimates for small caps is actually increasing. So we're going to be probably in Q1, Q2 2026 with growth rates for small caps and large caps technology companies at similar levels, while the multiples for the latter are double than the multiples for the small caps. That's another thing that eventually needs to adjust.
Yeah, and it's interesting. The thought just came to mind that when I see these rates of depreciation increasing for these hyperscalers, the thought that comes to mind is WorldCom and Global Crossing. When broadband was built out in the early 2000s, what was the capacity that was built out wasn't even used it was used single digits for a few years. So it took a long time to grow into that capacity. And I think we both agree that AI is a wonderful thing and it's got a very bright future, but people might be doing what they have done before, which is, with the rails in the early 1900s, just overbuilding capacity and paying the price in potential losses. And God knows there could even be some bankruptcies in certain businesses that are just only tied to that sector. History repeats itself.
That's right. It's the Cobweb model of investing. It's an abnormal profit. That abnormal profit is generally associated with overinvestment in capacity that drives excess supply of the goods or the services in question, which drives sharp price declines, which drives losses due to the overinvestment. And what you're essentially alluding to is this irresistible impulse that humans have to chase these opportunities, build overcapacity, and then suffer the consequence. And at the same time, all those industries were fantastic for the world, created incredible wealth, but investors behind the railroads or the fiber optic or maybe today the data centers may face very dismal returns. And I think that's something that we need to be wary when we think about history and when we think about the realities that we're seeing today. This post that you share with me, it really got me thinking. I think it would be great if you could comment what prompted you to pick it and send it over.
Yeah, I think it's fascinating. This was something that I saw in an interview that Jim Chanos was giving, and he had seen this in Grant's Interest Rate Observer, and I just found it fascinating. The fact that Amazon, AWS, would cut rental rates on NVIDIA H100 chips by nearly 45%, That is a massive drop. It raises questions. If we're in a price war, is there something else going on? Because we all hear that these chips are highly sought after and in short supply, but why would Amazon be doing this?
So these chips, the H100s, those chips used to rent for about $5 to $6 per hour. AWS just dropped them down below $2 an hour in some cases. If you do the math, what the hyperscalers are paying NVIDIA is about $40,000, and they're renting them out at $2 an hour. So if you do the math, if they had these chips rented 24/7 for 52 weeks every year, they wouldn't get to pay a quarter of the cost of each chip. That sounds like a strategic reset.
Yeah. It's odd because on the surface it seems like it would be a supply glut, right? But NVIDIA is still complaining that Taiwan Semi is constrained on production, and other producers like Google and Microsoft haven't followed suit on pricing. So it's really interesting to see AWS do this. And I think you're right. This is more of a reset and a strategic move by AWS. And kind of difficult to bet against them.
It's something that AWS has done before. It's something along the lines of what Amazon's always done, slashing prices to grab share. It's the classic loss leader move, locking the customers with cheap compute, then upsell on services, lock them in, APIs and integration, and then have them for the next round of technology disruption.
Yeah, it's also worth noting that AWS, Azure, Oracle, all these guys have been stockpiling chips. Azure apparently, or they reported that they have about 150,000 of the H100s. Oracle has hundreds of thousands in order. So it is a supply constrained market at the moment. And they're keeping the capacity controlled. You've got one player, which is NVIDIA, and you have Taiwan Semi, who's manufacturing for them. Of course, they have a good reason to keep supply constrained, to try and keep profits abnormally high for as long as they can.
This is fascinating. Additionally, Amazon Web Services is thinking in terms of NVIDIA's roadmap. And they know that the B200s are coming, then Rubin, then Feynman, and they know this is iteration after iteration that is going to force whoever is in the race of training and inference to continue secure space. So AWS may be clearing the space for the new B200 chips. They are launching those chips later this year. We know that the hundreds are still powerful. The Chinese would love to have them if they could get their hands on them, but they'll be yesterday's flagship soon. So the idea may be discount now, boost utilization, and monetize before depreciation eats into returns. Because if they think in terms of generations, they're losing money on this.
Yeah, it's well, it gets even more interesting because demand might still catch up. AI workloads are exploding. We're seeing exponential growth in the number of tokens generated, longer context windows, more multimodal models, and AI video, real-time inference. There's a good reason for what's going on, but I think this. It's really interesting to see the strategy that AWS is trying to play out, and there's also another wrinkle to this, which is if rental rates by hyperscalers are forced down, how are they going to make the money back that they've paid for these chips? And depreciation is going to start hitting them hard. And as you hinted, some underperformance by some of the Mag 7. These are names that have come out and said that they're lowering CapEx. And I kind of suspect that they might be lowering CapEx because they see this pressure on earnings coming from depreciation from a lot of these expensive chips that are going to be depreciated very quickly.
That's a very perplexing set of developments. At the same time that you see some of the hyperscalers pausing or doubting, you see Meta pedal to the metal, announcing massive data centers, build-ups, three generations of them going forward. And I think one of the reckoning moments that we had this year in Q1 was the DeepSeek moment when the chip-constrained Chinese found shortcuts to train models at a fraction of the capacity utilization that the leading-edge LLMs had in the US. And Satya Nadella hit the nail in the head when he said, this is harbinger of an explosion in use cases, creating what he called, or he recalled, is a Jevons paradox scenario. Compute gets cheaper, demand goes vertical. So you lower the price per token, and people just generate more tokens. And that may be the trick to soak up all this capacity, and then some. And if you are the winner, if you are the one who locked in the market share, you are going to ultimately regain the pricing power. So this bet that Amazon is making clearly needs to hit profitability in the short term, but maybe the right strategic move for the long term.
I think you hit the nail on the head there. I think that is more than likely what's going on. And Amazon's been always a long-term, highly strategic investor in the businesses that they've gotten into. So history's on your side, on your prediction. The other thing too is that Amazon has other revenue streams. So if they take a hit on rental rates for these GPUs, they've got other sources of income. And they've certainly got borrowing capacity, etc. So I think where we might see the problem are smaller companies that are just really into just data centers as a single source of revenue. So there's...
Now, the cardinal sins in investing is to make simple things complicated. And what we're witnessing here, and you know I'm a very long-term Microsoft shareholder, I'm very long-term Amazon shareholder, but I don't like the fact that rental capacity is being discounted 60-80%. And I think at least in the short term, there's going to be a hiccup. And who knows if the bet is going to pan out the way they think. Probably from a game theoretical standpoint, the dominant strategy for Andy Jassy, Amazon CEO, is a right one, but it's risky. So my question is, how do we play this incredible opportunity without having to answer so many difficult questions? Who are, the question is, the stable winners in all of this? I think they may not be necessarily the hyperscalers.
No, I think you're absolutely correct. Why would we go in and get into a business where people are just fighting to the detriment of their earnings? It just doesn't make sense. I think what we need to do is we need to look at the enablers. Let's just make things very simple. What does AI feed off of? Energy. And what is the source of energy that's going to be probably the cheapest, cleanest for the next 5 to 10 years? And I think that's probably points us into the direction of natural gas. It's a very compelling argument that we stay out of the fights and the wars and we just go with the arms dealers.
The Jevons paradox at its best. So 100%. Hyperscalers are in a capex race, and there may be winners, there may be losers, but in the meantime, they are in a capex race. And these are the warring factions. As you said, it's much better to play the arms dealers. What all this provides is virtually limitless demand for electrons. All of them are building data centers. All of them are massive manufacturers of tokens. There's going to be infinite use case for these tokens in the current LLM incarnation of AI and many other incarnations that are way more sophisticated we cannot envision yet. And electrons will require loads and loads of natural gas. AI data centers need power, and natural gas is still, before we get to nuclear, before we get to solar plus batteries, natural gas is the most scalable, dispatchable fuel source in the transition. And these companies are selling, the natural gas producers, these companies are selling the feedstock for electrons to run the AI boom, just as you just put it.
Yeah, that's right. It's there will come a time, I would posit, that you will see data centers located next to the wellhead, so that you cut the transportation cost of natural gas, and you just put the data center right next to the production source. There's an interview with Doomberg that where he mentioned that he wouldn't be surprised that at some point you'll see a data center in Alberta. Half the energy for a data center is basically to cool the equipment. So in Alberta it's cold, and you've got the net gas. So you'll be in a situation where you'll see a data center right next to the wellhead, and all the data can be moved by satellite or some other means. So as he mentioned, why would we get into betting on the warring factions? Let's just go and look at the arms dealers, and I think it makes for a much better risk-reward ratio.
We like range resources and expand energy. We actually liked expand energy since it was southwestern natural gas, and we also liked Chesapeake at the time. And I think that's one of the two vectors in which we can play the dominant strategy here, because it doesn't matter who wins the servers wars, the demand for energy is going to be there. The other vector that is going to help us win in this space is the picks and shovels. And the picks and shovels is whoever is helping manufacture the chips. They cannot produce chips if you don't have the equipment manufacturers. If you don't have AMAT, KLA Corp, ASML, even Teradyne, NVMI. So these firms make the tools to make the chips. The etching systems, in the case of KLA, the metrology equipment, in the case of ASML, the UV lithography. So regardless of what chips are used to create tokens, behind that manufacturing of any type of chips is that these companies are going to be selling their equipment and their know-how. So if NVIDIA or TSMC or Intel want to scale capacity, they need these guys.
Yeah, and that's where the Jevons paradox kicks in again, right? Every generation of chips gets more and more complex. So even if chip prices fall, the capital intensity of making them goes up. And that's great for, applied materials, for Lam. So more machines, more precision, more recurring revenue for them. So that's how we prefer to play the Technium thesis.
It's been very rewarding. They're not that cheap as they were when we invested in them, but they are still cheap. So to wrap it up, AWS's price cut doesn't seem to be panic. It seems to be strategic positioning. The real competition is for long-term customer lock-in ahead of a generational chip transition. They cannot afford to lose the market share war now. So who's winning? The Technium is winning. For those of you listening who haven't heard about the Technium,
Kevin Kelly, isn't it?
This is a term coined by Kevin Kelly. There is a fantastic book Kevin wrote a few years ago called What Technology Wants, and that's when he explains what the Technium is. And the Technium is winning, and the Jevons paradox is in full gear.
Yeah, fantastic book. It's one I would recommend everyone read. And what we're doing is looking beneath the headlines, right? Watching the enablers of the Technium, firms that are selling energy and picks and shovels in this AI race. So we think that these will have the highest leverage regardless of who wins the GPU pricing war. Okay, what we're also going to look at is nat gas. We've mentioned nat gas is the fuel that'll feed the AI revolution, and there's no substitute that can match it in any form for the next 5 to 10 years. Solar eventually will, with good battery technology, but that's going to take another 5 to 10 years. So nat gas is a good way to play the Technium in a very disciplined, risk-adjusted manner.
Yeah, and we mentioned a couple of companies that we like Range Resources. We like North America natural gas. We're not talking about European natural gas or Middle Eastern natural gas. So North American natural gas market is approaching a structural deficit. So similar to the uranium market in, let's say, 2018, where reactor demand outstripped supply. There are parallels in the natural gas space. There is supply faltering due to the plateauing of U.S. shale production. The decay rates are incredibly high. And there is, for all the reasons we just discussed, an increased demand for domestic. And not only there is increased demand for domestic, there is a large gap. You can essentially drive a truck between the price in the US versus Europe. And Europe is constrained in their ability to buy gas from Russia. And we're building LNG terminals left and right. And essentially, there's demand locally and there's going to be export demand. So we like the trend, we like the setup. And that's why we try to find companies that are in the space, and ClearRange is one of them. So that's creating a very asymmetric investment opportunity. And that's what we like. We like asymmetric because the first risk that we need to control and monitor is the downside risk. And when we are faced with these asymmetric opportunities, we get excited. So in the case of Range, they are very well positioned to capitalize on the rising natural gas prices as the market tightens. And it's going to tighten. Just the second half of this year, when all those terminals start operating and exporting natural gas to Europe, that will drive prices higher. This is going to boost Range's profitability, and of course, the price of the stock follows profitability. Today, the price in Europe, just for context, is about $10 per thousand cubic feet, or MSF, compared to domestic prices in the 3 to 4. The price is being oscillated between 3 and 4 in the US.
That's right.
So we're talking about 2.5, 3x multiple in Europe. If the prices were to converge, so Range Resources could be worth more than $200 a share, compared to the current trading price at about $38-40. So we're talking about a 5x here for Range Resources. They have a very attractive valuation and an outlook. And as we continue riding this Technium, reindustrialization, price arbitrage versus Europe, transitional clean energy, monetary repression, this is a winner. And we know there is another winner.
Yeah, EQT Resources is my pick. I know you like it too. Before I get into it, there's a few things I've learned in my previous career. My last job was a CFO of a mining company that had a project, a very big project in Peru and an operating mine in Mexico. So I do know a few things and have many scars from producing and trying to find natural resources. So it's very difficult to bring to production, to explore and bring to production natural resources. So as we go into this potential deficit in nat gas, this is where you really harvest what you've sown for many years. And these Range and EQT are basically two of the best companies out there as far as I'm concerned in the nat gas space. They're both low-cost producers. In the case of EQT, they're in the Appalachian Basin, in Marcellus and the Utica Shale, and they generate very robust cash flows because of their position in the cost curve. And I know a lot of people think, commodities eventually disappoint, but here we've got a situation where both of these companies are on probably in the first quartile of cash costs, which includes finding, developing, and operating these businesses. And that position is what Warren Buffett calls the moat. The fact that they produce the commodity cheaper than anybody else is the moat, because everybody else has to go out of business before they're impacted. And in the case of EQT, we've got great management with very good capital allocation discipline. They've been rapidly delevering, improving cash flows, and they've made some recent midstream acquisitions that are strengthening the company and giving them operational flexibility. Their performance, financial performance, has been very good. In Q1, they generated about $1.2 billion in free cash flow, which means that they converted about 50% of its natural gas and pipeline revenue into free cash. So that's pretty good. And they were able to also reduce debt by 40% between Q3 2000 Q1 this year. So these are all things we'd really like to see. And when we believe that this is a market where the commodity is going to rise substantially, you want these low-cost producers that are going to have huge operational leverage to the commodity. They're also very good at managing production to match up with market conditions and maximize profit. They've decreased production losses due to winter storms. So it's very good management, very good operators. And they also just bought Olympus Energy at 3.4 times EBITDA, which is pretty much giving them 15% free cash flow. So they've been making all the right moves as far as I can see on production, capital allocation, and operations. So I think that the stock probably is going to be in the 70s by this time next year, if the commodity does what we think.
It's very similar profiles. They are riding the same fundamental vectors. They are driving the energy transition. They are low-cost producers. They have great operators running the business with shareholder-friendly mindset, and they are going to be gushing cash whenever the price of natural gas gets tighter, and it's going to get tighter. It's just all over the tea leaves in terms of price arbitrage versus Europe and just the massive demand of energy that is going to be required to fuel all these data centers. So in the case of Range, I didn't mention, but it's similar to EQT. They're going to be generating $1.5 billion in cash. Today's equity value is $9 billion.
Yeah.
So just forget about valuation, forget about anything. I mean, it's very, very asymmetric bet.
Yeah, no, that's the operational leverage in these businesses is very good given their cash cost position. And they've been delevering, which I think is also a good move in order to have good balance sheet strength and pick up some assets through acquisitions like both of them have, because I think Range also made an acquisition not too long ago that was pretty good as well.
And we didn't mention the fact that they have a very large runway, because these have been savvy acquirers of acreage, very, very fertile acreage, and the room in the balance sheet enables them to, whenever the conditions are propitious, just spend that capex in new drilling, in new production that is going to be very accretive.
Yeah, and these guys, I think, certainly in the case of EQT, they've termed out their borrowing at least 5 years out. So they've got a good balance sheet.
Very good. It's been fun. We covered a lot, my friends.
Oh, we have. This has been a lot of fun, and hopefully the first of many.
Yes, I had a lot of fun. It was very intellectually stimulating. I think it's also very rewarding to do this with you. I learn a lot every time you and I chat. You bring very thought-provoking topics, and I see you next time.
Okay. All the best. And all the best to our listeners. If you love what you've seen, hit the subscribe button in our channel and follow us.
Very well.